So this is kind of maybe putting the brakes on or throwing cold water on some of these hopes of a lot of us that the number of home sales are going to rebound dramatically and that the rates are going to come down dramatically. I think if you've been paying close attention, and hopefully you have, you've been hearing some cautionary information around that actually happening. And here you have both Fannie Mae and the Mortgage Bankers Association revising their projections. Projections are dangerous, right? There's a lot of factors that go into them, but these are some of the large organizations that we look to for what may happen in the future. Of course, they don't have a crystal ball any more than we do, but they're looking at a lot of the data and making some assumptions around what may be happening in the economy. The jobs report, and that's ultimately one of the metrics they're paying close attention to as an underlying determiner of how the overall economy is doing. And of course, the labor market is softening, but it isn't breaking. We've seen unemployment rates go up to now 4.2% from some of the lows that we saw back in 2023 of 3.4%. So they've gone up almost, not quite a full percentage point in that time period, which means that it's certainly softening, but also, as I mentioned, not breaking. Also, the wage growth remains higher than what the Federal Reserve would desire. The Fed would prefer to see wage growth around 3%, but currently we're seeing wages grow at 4%. And I just want to make sure I point out that growing wages is not a bad thing, particularly for those people that are receiving those increases in wages. And yet it's a metric that the federal government's looking at to determine the strength of the underlying economy and therefore what they do with interest rates.